I think it's true with investments is people become attached to their style, their asset. And so I think it's hard, but we often tell people you got to be asset class agnostic, meaning, try to come at this from a beginner's mindset of not getting attached to saying, hey, I'm a gold bug or I'm a stock guy or I'm a Bitcoin gal, on and on. And so every asset having its time in the shade and sun. And so they go through cycles and we don't always know what's going to be the next big investment.
Welcome to the Advisors Fuel podcast, where high-performing financial planners and wealth advisors discover proven processes and actionable strategies to elevate their client experience, grow their businesses faster, and achieve unprecedented success. Here's your host, Adam Koos, founder at Adrenaline Advisor Consulting at adrenalineadvisor.com.
Welcome back to the Advisors Fuel podcast, the show for financial advisors who want to scale smarter, serve better, and build businesses that last. And a quick reminder, the Adrenaline Advisor course and community is now officially open to the public. Inside the program, I share the exact systems, processes, and tools that I've used to grow a seven-figure advisory firm, and you can check it out at adrenalineadvisor.com to learn more. Now, I'm so excited to share who our guest is today. In the midst of getting ready for the holidays, I got really fortunate, and we have the one and only Meb Faber, co-founder and chief investment officer of Cambria Investment Management. He's also the host of the Meb Faber Show and a prolific author whose work has appeared in the New York Times, Barron's, and the New Yorker. He holds a double major in engineering science and biology from the University of Virginia and carries both chartered market technician and chartered alternative investment analyst designations. And through his firm, Meb manages Cambria's ETFs, separately managed accounts, and private funds for accredited investors, focusing on actionable, rules-based strategies covering smart beta, trend following, value, yield, real assets, and tactical allocations. So whether you're out for a walk or just sitting on the couch, get ready for an intriguing conversation with Meb Faber. All right, Meb. Well, thanks so much for joining the show.
Great to be here.
Yeah. So I've been looking forward to this one for a long time. I've been following you for years, became a technician myself back in 2008, and you were one of my early mentors, and you didn't even know it. How's that?
Great, man. I love it. It's funny. There's an old quote that says, somebody's talking. It's like, I've never met a rich technician. And my favorite example used to always be Marty Zweig. So for the old people listening to this, Marty Zweig, go back to Fosbach and all these other authors, Nelson Freeberg, writers from, 50 plus years ago. There's so much wisdom in the archives, but, he used to own the most expensive penthouse in New York City. So I used to tell people, I said, there's plenty of examples of technicians. The modern age, they just have fancier names like quants, right? That's what the technicians are called in 2025 is quants.
Yeah, you got to put that on my business card. Never mind,
Yeah.
I don't have a business card anymore, I guess, so whatever. One of the things I know is that we have somewhat similar backgrounds. I went to college and studied biology, chemistry, microbiology, among other similar courses, and with plans to be a trauma surgeon. I want to go to med school, and I ended up being a financial surgeon instead. But you started with a dual major in biology and engineering at UVA, and now lead, I'm going to say it, quantitative strategies. Right? Quant. So I'm curious, with what you're doing at Cambria, leading these strategies and ETFs, you've got to elaborate on your story. How'd you get from there to where you are today?
Sure. Well, we'll start at the end and work backwards, teleport to the beginning. We have an ETF company now. By the end of the year, we'll have 20 funds. We're currently about $3 billion in assets and pretty wide and diverse lineup. And like you mentioned, rules-based quant. If you could go back a long time ago, I graduated college during my favorite bubble, the internet bubble, the late 90s. There's definitely some rhymes today. You look at these stock markets and I see the youngins trading meme stocks and crypto and zero-day options and prediction markets. And, I can't be too dismissive. That would have been me in my 20s, I think. But you learn a lot of lessons when hopefully you're young and not with a lot of money. One of my favorite Wall Street quotes is, every trade makes you richer or wiser, but never both. And so my youth, and still to this day, Certainly, the wiser category is long and lengthy, but that's where you learn. That's where you get the scars. Anyway, so late '90s, internet bubble. Kind of came out of that working and going to grad school, still in the biomedical engineering world, but worked at a biotech mutual fund. And everyone remembers the internet bubble, but it was also a biotech and sequencing the genome stock bubble. And I think, the fund and the category probably went down also 80-90%, just like everything else did in the dot-com world. But, out of that wreckage and ashes grew a lot of amazing companies, Google and Uber and on and on. So, but started gravitating more and more to the quant side of the world. Started writing at the time, blogs, what we used to call it, and academic papers. And a funny sidebar story, the first academic paper I ever published, which was for the CMT curriculum, was called A Simple Approach to Market Timing.
Yeah.
And
Yep. I'm
there's
familiar.
certain, well, we eventually changed the title to A Quantitative Approach to Tactical Asset Allocation because there are certain phrases in not just investing, but in all of our lives that have a lot of emotional baggage. And in our world, certainly market timing is one, right? That is a phrase that is just fraught with so much negative association. So when you change it to something that sounds very sophisticated and institutional, like tactical asset allocation, doesn't sound so bad. Quantitative, same paper. All of a sudden, everyone would read it. But it's just a funny example. Um, Never intended to be a writer or put out content, but here we are. Who knows how many books and articles later, and fast forward to today. All right, sorry, that was the short overview.
Yeah, no, you're good. Um, what would you say, and I think I'm gonna know some of these answers, but I wanna talk about what are maybe the one or two biggest widely accepted investing beliefs that you're skeptical of? If we're talking to all the financial advisors that are listening to or watching this, maybe even something you publicly challenge now or have in the past.
How long we got? We doing 5 hours? I have a Twitter thread called "Things Meb Believes That 75% of my professional peers do not believe," and that's up to about 20 items. And then I also this summer am almost done publishing a series called "20 Things You May Not Know About Investing or That May Surprise You." And I think if even most pros were to go down this list, I think most would, at least half would surprise them. So there's some the easy and famous ones. I think the most universally held belief in all of investing, and I because in the way that I think about it, I don't know anyone that doesn't believe this, is that stocks outperform bonds, right? The stocks for the long run, and I absolutely believe that over time they do. Um, however is the massive asterisk here. What people think is a time horizon is the biggest disconnect in probably all of our world, is the time horizon which people expect and want certainty, and the time horizon which markets deliver that. And so if you look at periods where, for example, US stocks, which have been the premier asset the last 15 years, been amazing, one of the best periods ever for investing in the US stock market, 15% a year, get pretty rich pretty quick at compounding at those rates. So it's been a 10 bagger, or if you've been in kind of the queues, a 20 bagger since 2009. But there's periods throughout history where stocks underperform bonds for decades, stocks go nowhere for decades, stocks underperform other stuff like REITs or gold. I think it'll surprise people to know that stocks have actually underperformed REITs and gold this century, going back to when I graduated college. So there's all sorts of little fun, ideas, but the big one being, that stocks are always going to win and always beat everything is, of course, dangerous. We're writing a new book, hopefully be out by year end, aimed at the youngins, the young folk. It's called Time Billionaires. And it looks at kind of global stock markets back to 1600. And indeed, you want stock ownership. That's how people can get wealthy from any background and starting at zero. And but it's fraught with all sorts of geopolitical, emotional stressors every year. There's been something just awful. So that would be a first start. So despite being the premier asset, and it's a fun quiz for the listeners. My favorite investing book, Triumph of the Optimist, profiles all the global stock markets back to 1900. And people always assumed the US was the best performing market, and it was exceptional. But actually, tiny South Africa and Australia were slightly better.
Hmm.
But plenty of countries went to zero in the interim, like China and Russia, and others essentially went to zero or had massive drawdowns. So you had to stay the course, which, of course, has been the tough part.
That's the hard part. So I'm not sure how many people know this, but you know, um, we talked about this earlier, just for briefly. But one of the things you're famous for saying or pointing out is that not much good happens below the 10-month moving average, and that line has almost taken on a life of its own in investing circles, certain investing circles. Can you share maybe how in the beginning that idea came to be, and maybe talk a little bit about how it relates to some of the different solutions you've built at Cambria for advisors? For those who want to put some of these concepts into practice, because was it literally just looked at a chart one day and we're like, hey, that made sense? It was that simple.
Yeah. I love investing quotes. We do a quote of the day on Twitter because some of these are so funny and timeless and accurate in many cases. But often you'll see Wall Street quotes and not sure to who to attribute them to. It's like everyone's attributes everything to Mark Twain or Einstein. In our world, I just go ahead and attribute it to Morgan Housel or Mark Yusko. This one, I think I would have to get credit to Paul Tudor Jones, who is a very famous investor, hedge fund manager for many decades now. He wrote I want to say the foreword to a very famous investing book, Reminiscences of a Stock Operator by Jesse Livermore or AKA Edwin Lefevre. But the concept, some of the most timeless investing ideas, there's two that we talk a lot about. One is extremely familiar to almost every American. That's value investing, right? Warren Buffett, Uncle Warren, talking about buying something, at a margin of safety, lower cost. I mean, that idea goes back certainly 100 years, but probably hundreds of years in some form. But really is popularized by Ben Graham and others. Security analysis, intelligent investor. On the flip side, the concept of trend following also certainly goes back over 100 years to the time of Charles Dow. He started the Wall Street Journal, as well as talked about Dow theory. And there's been so much in the literature about trend following over the past 100 years. And, the most popular cited metric of trend is something like a 200-day moving average, which is essentially the same thing as a 10-month simple moving average, which is the one that we talk about. But the reason we use monthly is because A, it's a lot easier to find monthly data going back a lot further. And B, I'm lazy. So I don't want to have to look at stuff every day. But once a month sounds like just plenty. And even the more modern interpretation, Jack Bogle on the Mount Rushmore of investors, certainly for education and practitioners, his massive innovation of making the market index investable for very low cost, that index is a trend following index. A lot of people, I don't think, want to admit that, because it sounds like it's market timing, et cetera. But at its core, there's no other variable in that index other than price, the stock. And so as that price goes up, you own more of the company to the point where you get a whole boatload of NVIDIA, which is what, 4 trillion today market cap. And as the price goes down, you own less and less until it goes away or gets kicked out eventually for being too small. That is the world's simplest trend following strategy. So you go back to the old idea of trend. I think it goes back to the whole concept of power laws in investing. In a power law, if you're not familiar, listeners, something like earthquakes. I live in LA, so that's my example I like to use, where something that's 4.0 on the Richter scale, if you go up to 5.0, that's not 25% worse, it's 10x. And so it's a logarithmic sort of step function. And if you look at investing, it's a similar situation where the vast majority of investing returns, and you look at some of the best and binder papers, are driven by the top 5 or 10% of stocks. These 10, 100, 1,000, 10,000 baggers that generate all the wealth over time, over very long periods. We were chatting with Hank, And he wrote a follow-up to his famous paper, "Do Stocks Outperform T-Bills?" Where he was looking at the best performing stock of all time. And this was kind of a fun one. We asked him, said, over the last 100 years, what's been the best performing stock? And, there's two parts to this idea. Everyone's going to assume, oh, had to have done 50% a year or 80% a year. And it only, quote, did 16% a year. This is reinvesting your dividends. But that's Philip Morris, right? That's Altria as it's called today. A total percentage gain of 265,528,901%. So not so bad, right? But the concept being is that very few investments will drive the return, but also all the good stuff happens in uptrends. And in downtrends, the volatility explodes. There's some emotional, behavioral reasons for this. If you listeners, many of you, the youngins, will have not experienced a real bear market. These little 20% jiggles by the dips, I'm not counting those. 20% is really the inflection point in my mind, but every 10 percentage points down, it's like the Richter scale gets exponentially worse and people start to lose their mind exponentially more at down 30, 40, 50, 60, 70, 80, 90. But historically, the volatility explodes because if you've ever seen anyone who's down or losing money, you ever been to a poker table, seen someone go on tilt, if you've ever seen someone spin themselves up into a gambling spree and crash out, on, where they lose money, people act totally insane. It becomes extremely emotional. And that's where the volatility historically is much, much higher when you're in downturns and downtrends than in uptrends, where we are now, which is just cruising along to the upside.
I remember, I haven't said this in a while, but that got me thinking about the fact that if you're 36 years old, then the market peaked in 2007 when you were 18. So the math I guess I've used in the past is, and I guess that would be probably 40, 45 years of age, because when you're 18, you don't have any money. When you're 22, if you go to college, you're getting out of college, you still don't have any money. So that would be 40 years of age. So at what age would someone have to be today, when you think about it, before they'd actually have money in a 401k, let's just put it, to experience a real crash? And at this point, it's really, when you say that generations haven't seen a crash yet, I mean, you have to be pretty old at this point. I say pretty old, sounds like
you got to live outside the U.S. We gave a couple examples. Investors love to put all their money in their own home, their own country's stock market. So you go to Japan, Japanese friends put all their money in Japanese stocks. Ditto for Brazil, UK, on and on and on, right? But it's also true in regions. And so it's also true, interestingly enough, when you were born. So the very direct experience you've had in your life, Vanguard has a great chart of equity allocation based on vintage of when people started investing, essentially their age. And it's hugely different. And it's hugely different based on what was going on at the time, right? It's like my son or anyone who's, kind of 7 to 12 years old, their formative sports memories, they're probably all Chiefs fans. I'm a Broncos fan, so that's hard to reconcile. But I remember being a kid, and it was the amazing Mets of the 1960s with Dwight Gooden and Darryl Strawberry and Gary Carter and everyone. So I think it's like these very formative memories where, had you been born in the 1980s, or excuse me, had you been investing your career during the 1980s, like, what an amazing time to invest, one of the best decades ever.
right.
And then on the flip side, the early 2000s, like if you lived through that was your period. You got smacked with the dot-com bust, thought things got better, and then got smacked by the GFC back to back. You have a totally different perspective. And also someone that lives in, say, Japan, where stocks peaked, in the 80s and went nowhere for 3 decades. My goodness. And there's a million other examples of smaller countries where you have hyperinflation, you have all sorts of, certain stock markets that have gone nowhere for 30, 40, 50, 60, 70, like on and on years. Like you genetically and behaviorally, it makes sense. Like you should learn from your environment, but the problem is you then extrapolate it. And as we all know, the future is it's not the past.
Yeah. I got to share because you mentioned earlier quotes. My favorite quote of all time in this business, it goes, the disservice done students and gullible investment professionals who have swallowed efficient market hypothesis has been an extraordinary service to us. In any sort of contest, whether it's financial, mental, or physical, it's an enormous advantage to have opponents who've been taught that it's useless to even try.
This is Buffett. It's got to be Buffett.
Buffett in 1988.
Wow, 88. I love the old school quotes. We love trotting out some quotes of his from the 1980s on stock buybacks because people love to repeat all the time stock buybacks used to be illegal and all these other things that are just not true. And it's funny, on my bookshelf, we have books from the 1970s about stock repurchases and on and on. So Buffett is, he's quotable. He's one of the best.
If you survey 50 financial advisors and 50 investors and you tell them what quote that was, they're not going to say Buffett.
What are they going to say?
Well, I think everybody looks at Buffett as this buy and hold, never sells anything kind of guy. And I don't know.
One of my favorites on talking about, if you were to say, all right, who's the most buy and hold investor of all time? Jack Bogle, John Bogle, like boom, boom, boom. Like he that's his shtick. The Bogle heads, they always get up in arms with me. I don't know why, but he's got a great video on YouTube from where he's talking about the late 90s and essentially how he shifts his asset allocation based on valuations of the stock market. And I'm like, that's called market timing, right? Like that's, that's literally what that is. And, he's reasonable. He's like, look, I didn't go from 60-40 to 100-0 or 60-40 to 0-100. He's like, I went from like 60-40 to like 40-60. But he published papers. There's one called Bogle's, it's like Occam Razor, where he distills the stock market into its individual components as a way to forecast future returns. Now, he may just call it as expected returns, which is just starting dividend yield, earnings or dividends growth, and then change in valuation. And it's a very simple, you can throw in the numbers and come up with a pretty good guess of what stocks are going to do for the next decade. Obviously, you don't know for certain what earnings, dividends, growth are, and you don't know for certain the change in the valuation, but starting valuation and dividend yield. And so it's interesting because Vanguard publishes a lot of these capital markets expectations, and they often are quite a bit different than what I think fits along with back to the earlier comment you made when we were talking about thinking about a downturn but staying fully invested, where Vanguard will say certain things, you'll be like, well, how can you say to stay fully invested with what you just said? If you think stocks, large cap growth is going to only do a couple percent, and you think everyone should put all their money in international bonds, like, let's see it. It's like the diagnosis versus prescription. Are you going to actually do anything, or are you just going to talk about it? And anyway, I think that's one of my favorite quotes. We'll send you the video if you can't find it.
That'd be great. And then I remember, the name Paul Guyer. He did the, best versus worst. Because I think one of the biggest misconceptions when you look at the research that says if you miss the best 10 days in the market, best 20, best 30, best 40, here's how your return erodes. But nobody ever did the research until Paul Guyer did way back. I think it was in like the 90s, maybe early 2000s, where he said, well, what happens if you miss the worst 10 days, 20 days, 40 days? And my favorite was, what if you miss both? And so actually in 2011, I think it was, we did a redux I actually called him and asked permission to do a redux on his study, and the numbers didn't change. And I need to do it again, I guess, because it's already been 14 years. But I mean, what frustrates me, I guess, is that the reason it's not unlike, certain, maybe I'll call it rumors out there when it comes to pharmaceuticals, drug companies write their own approvals, FDA approves them. The reason why, in my opinion, some certain funds maybe don't want you to sell is because they don't get paid if you sell.
Yeah. Incentives rule everything. That's the old Charlie Munger. We got Buffett's quotes. We got to include Charlie. You show me the incentives, I'll show you the outcome. It's a great one. But look, I mean, I think there's a lot of investing sayings. There's a lot of misunderstanding through markets. Not all of them are necessarily, bad intentions. Some of them are people that just don't know. Some of them are a salesperson that gets a hold of it. There's a lot of great examples of those. You get a private equity person trying to sell you private equity and claiming it's a 4% volatility, right? That's
Huh.
like you're probably really questionable morals and ethics on that one. But we've seen a lot over the years, like the one you just talked about the worst days myth. That was one of the first papers we ever wrote. I mean, it's a picture of me, I think, clean shaven, wearing a tie, but it applies to every market around the world where, most of the good and bad days occur in the downtrends. And that's just because it's more volatile, right? And you often do better by avoiding both, which is kind of counterintuitive. But, people co opted that by saying, look, you need to stay invested, which, to be clear, um, for the majority of people out there, if you got a diversified allocation, is great advice, because for a lot of people that are trying to do it on their own, just winging it, like almost everyone I know that's shifting their allocations is doing it by the seat of their pants. And my favorite example of why that's a terrible idea is like you look at a lot of the sentiment surveys, and the peak of all of them was late 90s. The highest reading ever on the bullish survey for AAI was December 99, like the literal worst time in the entire history of investing to be bullish. And then the flip side is like, when were people most bearish? It was March 2009. And so I think if you have a process, that's a different story, but most people don't. They buy stuff, they wing it, they see what's gone up over the past couple of years, they see what their neighbor had to say, and that's that. But the reality is, and kind of this is the thesis of this book we're writing is when it hits the fan, what are you going to do? And a big problem with this too is a lot of people don't write down their process. They don't have an investing plan. And so, if anybody's ever been on a diet, you know why that doesn't work, or an exercise plan, right? You're going to reach for that cookie at midnight, or extra serving. So, same thing with investing. Another one that kind of hits my funny bone is I don't think most investors realize that the income they get from stocks, you have to reinvest to get the traditional 10% return. You can't go spend that, people. Like if you want to go to Cabo and, drink a bunch of pina coladas, like you can't spend that income. Now you can spend it if like you want to, but you're not going to get your 10% return, right? You're going to get a fraction of that. Anyway, how do we get to that topic?
I don't know.
You got to corral me.
But now I want to go on vacation. So,
Yeah.
let's get back. It's actually a good segue to Cambria. Because you're one of the things I like about you and what you do is that Cambria's ETFs look much different, I think, than a lot of the big firms out there. You guys emphasize rules-based models, like you were mentioning. You have some trend following, aspects to the models. So, what do you think? I always like to say over time versus all the time, but especially in today's market climate, why do these strategies you think they make sense? Why would you say they're persistently effective?
It's the best time ever to be an investor. Honestly, you can get access to the entire world for almost nothing. Now, the bad news is that's the same challenge of walking to your local grocery store and walking down the cereal aisle. There's going to be some stuff that's, let's be honest, it's all probably not healthy, but there's varying degrees of that. But it's limitless choice, and I think that's a struggle for most people. They end up with kind of this patchwork salad approach to investing when they end up with hundreds of unrelated funds, and it's just kind of a mess. Um, I think a great starting point we often tell people is like just buying the world. We think it's very important to be global in nature. The U.S. is a majority of market cap, true, but only a quarter of world GDP. So looking beyond our shores, and equity is being obviously the premier asset, but fixed income in many ways has a nice diversifying effect as well. But also real assets, thinking of things like REITs, real estate investment trusts, TIPS, commodities, commodity equities, and coming up with a portfolio. If you rewind, like by far the biggest decision is the decision to save and then put that money to work in the first place. Like that trumps all other decisions. It's not even close. Then, you have to put it in assets that pay you, or that are capital cash flowing assets that historically have done a good job. And so coming up with a portfolio, doing it low cost, low tax efficient, high tax efficiency, like that's kind of table stakes. Once you get there, then you can kind of move in and start to do other things. But already right there, that probably puts you better than 99% of portfolios out there. And so, kind of a lot what we do is actually like pretty concentrated, weird, and different. And that's by design because we don't charge 2 basis points like some funds do. We charge more, but we want it to be ideas that if you're going to be active and move away from these broad indices, like you want to be real active. And so we come up with all sorts of different ideas, whether it's trend following, whether it's shareholder yield, whether it's tail risk, whether it's kind of unique ideas like equities targeting low or no dividend yield, on and on. We have some allocation funds. They're all quite a bit different and unique. Some are very niche and very focused, and some are much more broad.
One of my favorite uh, mini, call it case study stories to tell when I'm doing a speaking engagement is to say, let's pretend all of us in the room are in a stock club, like an investing club, and there's 100 stocks in our portfolio, and each stock is worth 1% or $100,000, so $100,000 portfolio. I say and then I usually pick a local company. I'll say, Cardinal Health. How many of you, by show of hands, think Cardinal Health is going to go up 100% between now and the end of the year? And most times nobody will raise their hand, but I'll say, humor me for a second. Let's just say Cardinal Health, one of those stocks, goes up 100%, all things held constant. Nothing else happens in the market, the portfolio. We make 100% on Cardinal. What's the return in our portfolio that year? And very rarely, it takes some time because people don't want to be wrong, of course, but it's 1%, right? We made 1%. And the point is, there is a lot to be said for concentration as opposed to diversification to a certain extent, because even though we all agree Cardinal Health's not going to go up between now and the end of the year, even if it did, we'd only make 1%, right? So I don't know. One of the things I always like to say about investors or human investing is that humans, they suffer from, the best thing about them is they suffer from this severe case of recency bias. And the worst things about them is they suffer from a severe case of recency bias, right? So how would you say you mentally reconcile the tension that exists between, say, a long-term buy and hold strategy investor, high RS versus high RS, or reactive trend following signals, and maybe even just patience or lack thereof?
Yeah, we did a 4-part series during the COVID pandemic. One was called the Get Rich Portfolio. One was called the Stay Rich Portfolio. And then we kind of went into some other topics because everyone, markets back then were going up, down 5-10% in a day. Everyone's losing their mind. Felt like the zombie apocalypse. um, and so, I think for everyone, there's different ideas and different approaches. And we've talked a lot about this in the past. So let's say you've made it, you've won the game, and you're rich. Well, you may not care about necessarily being super concentrated and trying to hit the ball out of the park. You may just at that point just want to hold on to your wealth. Or you say, look, I'm rich and actually I'm not investing for myself. I'm investing for this foundation, in which case I still do want to hit the ball out of the park and do 10%. So I think a lot of times we always um, try to reduce investors to they're old, they shouldn't be taking on a lot of risk. They're young, they should take on a lot. But it's a little messier than that. And then on top of that, it's I think a challenge on trade-offs for how people behave. Will they behave? And from what we've seen, the more volatile it's hard for people. A lot of the research shows the allocation style funds, the target date funds, people tend to behave a little bit better than other types of extremely volatile strategies. But we manage both, and so I think for particular use cases and ideas, like I'll give you an example. Foreign stocks have underperformed U.S. stocks for feels like forever, but historically it's kind of a coin flip. And we try to educate our investors. We say, look, a lot of the investing world, they'll only tell you what's working, and they'll certainly, if you go on Twitter, no one has any losing trades, right? Everyone's making a ton of money.
Yeah.
And it's easy to talk about what's winning in marketing, but to me, it's important to also talk about what's not doing well and why. And so we had a strategy that buys global deep value stocks. So really super cheap countries, places like Poland, places like Turkey today, UK even for a little while. And that strategy was out of favor for quite a while. And we wrote an email to all of our investors. We got over 150,000 investors. And we said, we're profiling this fund, this strategy. And the title is called Totally Not Crushing It. Like we said, like this has been awful. It's been bad. Is the strategy broken, or is this just a natural ebb and flow of markets where something's always doing great and something's always doing poorly, vice versa? I mean, gold's a great example. You had gold all-time highs last couple of years, amazing returns, but other periods went nowhere for decades. So anyway, but that strategy of global value, I think, is up over 40 percentage points this year. So it's just having a monster year. But it just kind of goes to show that these things come in and out of favor, but it's hugely concentrated. And, I think I think what I'm getting at this whole topic is I actually published that the average mutual fund manager has $0 invested in their own fund, which to me feels
Crazy. Yeah.
unfair or a bit wrong. And so I put all my public assets into our funds and strategies. And every couple of years, and I'm due for one because I think the last one was 2022. I just published. I said, "Here's how I invest my money." Um, but I said I'm a skier. It's sort of a chairlift philosophical conversation because you could detail the initial conditions, and the person sitting to your left would come to a totally different conclusion. The person sitting to the right, And so I think finding what works for you as an individual is like all that matters. And the whole point of all this, remember, is not just to get the biggest number. It's what are you using these assets for? Like, what's the whole point? And for many people, it's just preserve and grow your wealth. But like, for what? I mean, well, to pay for kids' education, to go on trips, to feel financial freedom, to endow a scholarship, whatever your goals are. The problem is a lot of people, they just keep running on the hamster wheel forever. So you got to remember, there's a whole point to all this at the end of the day. And so, but I think coming up with a robust, diversified portfolio, for almost everyone is that will behave in most market environments is probably the best starting point.
One of my favorite quotes is that money is a unit of choice. The more units you have, the more choices you have.
Oh, I like that. Who is that? Is that
I have no
unknown,
idea.
anonymous?
A friend of mine in 2001 told me that when I was finishing up college, and it always stuck
Good.
with me. But speaking of human psychology, I know I'm leading you here because I already know we both agree on this topic, but it's something that kind of burns me. What would I mean, how overrated would you say dividend investing is as a strategy?
Oh boy. So if you look at the long history of investing, we're talking about going back to the 1900s, 1800s, 1700s, 1600s, really the first joint stock companies in Amsterdam. For a long time, the whole point of investing in a company was the dividends. Like people didn't expect for there to be capital gains. Like you would have these bubbles where the stocks would 10x. South Seas, Mississippi Company, railway, canal manias, on and on. There's a million of these stories. But often people, they kind of saw stocks and bonds as similar, like they were looking for sort of the income part of it. Um, that changed a little more in the 20th century. And you got to remember, the vast majority of 20th century, most people still didn't invest, and probably in the US, like half of households probably have no real stock exposure outside of their retirement or pension, type of plans. Um, but if you look at the point of a company historically, is they generate cash flows and distribute it to their shareholders. And that's all well and fine. So historical dividend yield, let's call it, like 3, 4, 5% or something. And today it's 1.2. Lowest it's ever been is 1.1. I believe in the internet bubble. And there's some reasons for that we can get back to. But I think what you're alluding to is a little more about is like sorting companies on dividends or high dividend companies. And that's sort of a different question because dividends, all they are is just returning cash to shareholders. And that tilts you towards a certain company or stock. So if you're returning a certain percentage of your market cap in cash, you have to have that cash, or you have to be generating it on a yearly basis. So it kind of pushes you towards companies that are established and making money. Your startup biotech stock's not going to be paying dividends for that reason. Um, However, if you're doing a high dividend yield strategy, that almost inherently means that the price of the stock is down or is low relative to the dividends it's paying. And the reasons that is historically is that the company is a little junkier, so they have more debt. Um, but they often are, it gives you a tilt towards value. Now, it's not an explicit value tilt, like saying I'm going to buy price to earnings or cash flow or certain other measures, but it's a rhyme, like it's a first cousin of value. So historically, over time, if you invest in high dividend yield strategies, historically it'll beat market cap by 1% or so. But almost everything beats market cap by 1% or so. And the reason being is that market cap weighting has no tether to fundamentals at all. So when things go totally crazy to the upside, you put most of your money in the stocks that have gone up the most and the highest weight, which could go on for a long time or it might not. And so a value tilt, I think, is helpful in general. I think it's been totally bastardized and misinterpreted over the years. Going back to what we were talking about earlier, there was a lot of studies, charts and tables published on dividend growth that were faulty, and how many hundreds of billions of dollars focused on certain types of strategies that may not have had legitimate underpinnings. And so I think, like any strategy, the weird part is, if you tell me, like, there's a whole list of things on one side of the world that's like totally okay, fine, whatever, and on the other side of the world are like no good, terrible, absolutely do not. There's plenty of things that I'm like totally fine of. You said, Meb, I'm an investor. I buy 20 high yielding dividend stocks, rebalance them once a year. I say, look, that's probably fine. Like I am not going to complain. Now, again, you got to reinvest those dividends if you want the 10%. If you spend them, and if you're in retirement, whatever, you want the income, God bless you. But I think, like any strategy, goes in and out of favor over time. So dividend stocks, for example, in the late 90s hit the biggest valuation discount to the overall market they've ever seen. In the mid 2000s, they actually traded at a valuation premium to the overall market, which is crazy if you think about it. But that's because everyone was in search for yield as we got into that low interest rate environment. And so there's certain investments that at sometimes look like a really fat pitch. They're much more attractive, and other times they're on the flip side. And every single asset, doesn't matter if it's Bitcoin, gold, foreign stocks, REITs, tips, kind of goes through those cycles, for better and for worse.
One of my favorite dividend story to tell, and the reason I think one of the many reasons why I feel the way I do about them, is a prospective client coming in. I think it was in the early 20 teens, talking about how they wanted to transfer everything, but the one thing they didn't want to sell was this one stock because it was paying a 24% dividend. And I don't know why or how I guessed it. 10 more times, I would have never guessed what it was. But for whatever reason, this day I just happened to guess. I was like, is it American Capital Strategies? And he says, yeah, it is. How'd you know? I was like, well, because it was a 12% dividend a couple of years ago, but it's fallen in half. So now it's paying 24% because it's worth half as much, And I think that's another thing most investors don't realize, is that when you're just looking for yield, that doesn't necessarily mean you own a great stock.
Yeah. Yeah. The markets are pretty efficient. Going back to your comment earlier, they're not totally efficient, but on average, they tend to be broadly efficient. One of the great quotes we love from Rockefeller back in the day, which I think is so funny. He says, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in," which I think is so funny. But people love this idea of passive income. I think they take it to the extremes. I think a lot of people don't understand how it actually works. But again, it's to each his own.
What about bonds? So they've had a brutal stretch since COVID. Probably one of the most, I don't have the data, but probably one of the worst multi-year runs in modern history anyway. Now we've got, the Fed talking about rates maybe looking to finally get cut. How do you think this plays out? Are we going to finally see bonds reclaiming their seat at the table here? Are they right to still be skeptical, investors?
Like dog species or all sorts of stuff. There's a million different variations. So you got things like T-bills or 10-year government bonds, or things that are a lot, more volatile, like emerging market bonds or zero coupon bonds. You got tips, on and on. But on average, I mean, bonds are a lot easier than stocks. Bonds pretty much will give you the coupon unless they default, which on the government ones, you don't have to worry about that much. Um, and it's a very high correlation over time. Now, that's a nominal return. So the real, what is the inflation going to be over the next 10 years, is the big lever, where one of my favorite quizzes to newbie investors and pros alike is say, if you look at what's the safest asset in the world, and this is a title of a paper we wrote, and most people would say T-bills, and that's true on a nominal basis. Like, they don't go down ever. They just pay out an income, and that's that. But on a real after inflation basis, T-bills have lost half before. So you put all your money in T-bills, God bless you, but at one point you lost half your money because inflation was higher than the bill rate. And so, that's oddly enough, the safest investment turns out to not be T-bills or any individual asset. It turns out to be a diversified portfolio of things like stocks and bonds and real assets. So you actually should invest the majority of, quote, your safe money, which is a bit counterintuitive to people. I mean, I think bonds play a unique role often, but not always. If you look back and say, man, why were we buying bonds at 0%? Like, that's a head scratcher. Like, what were we thinking? Like, that, what a dumb idea. And here we are later, and all of a sudden bonds yield, 4-5%. And so you got a lot of the older folks, it's like Christmas, like they had no yield for forever, and all of a sudden you got 5%. The big warning that we feel currently, and a lot of things we talk about are there's some consensus on what the world believes. This is not one of those. I don't understand why the vast majority of the bond marketplace doesn't have more yield, meaning corporate bonds are some of the tightest spreads they've ever been relative to T-bills. We wrote a paper on this too. That's a common theme you'll hear me. I say we wrote a paper on this, but we got a lot of papers and books out there. Most all of them are free. But this was called T-bills and chill. And if you look at historically, like, you want a margin of safety on the risky bonds. If you're buying junk, it should have a yield spread pick up over T-bills. If you're buying emerging market debt, on and on. And the vast majority of the curve doesn't have much juice. And so historically, if you buy these things when there's not much spread, it's a pretty bad idea. And you underperform T-bills historically. And so this doesn't have to ever cure itself, but either the entire risky yields need to go up, or the lower end T-bills need to go way down, or both. The spread needs to widen to make it interesting. So, like right now, I think and same thing in the stock world. There's some pretty interesting opportunities for a lot of the small caps, a lot of the value, a lot of the foreign that have been underperforming forever. So bonds, I think they can play an interesting role as a diversifier. I also think, as a lot of people found out in 2022, they don't always diversify you. I think a lot of people have been lulled into it, as we were talking earlier about history. The early part of the 20th century, bonds often didn't hedge stock drawdowns. It's kind of like gold. It's like gold, like sometimes when stock hit the fan, it's like, does it help? Well, sometimes doesn't help. So can't count on it. Can't count on almost anything in our world of investing.
Nothing
But bonds,
certain. Yeah.
5% certainly better than zero.
Nothing certain. But
Yeah.
gold, I was actually my next question. You've got one of this polarizing asset in gold. These debates, on Twitter, whether I don't know. I mean, obviously the drivers are inflation rates and the dollar, and you just mentioned inflation a second ago. So from your perspective, I mean, what are the most important drivers advisors should be paying attention to right now, and how do you see that, gold being an asset fitting into portfolios today?
You
And
know, we wrote this old book, and I'm trying to update it because it's been about a decade, called Global Asset Allocation. And it looked at all these famous allocations from different investors like David Swinson and Buffett and Rob Arnott and on, and kind of look at how they performed over the last 50 plus years. And it's interesting because they were hugely different. Some said you should put 25% in gold, some said zero. Some said you should put almost everything in US stocks, and some said only 25%, on and on. And over time, they all did well, right? They all kind of moved up and to the right, but they took a very different path to get there. For example, in the 1970s, man, that was a tough decade. to be an investor. And if you didn't have real assets like gold, it was even harder. And so other decades, the premier asset like the 80s and 90s, just equities. You got a bunch of equities, great. Early 2000s, anything other than equities, foreign, REITs, small cap, on and on. And I think this is hard for people because we all become attached. Probably a Browns fan. I'm a Broncos fan. You know, you couldn't pay me any amount of money to switch, but I think it's true with investments is people become attached to their style, their asset. And so I think it's hard, but we often tell people you got to be asset class agnostic, meaning, try to come at this from a beginner's mindset of not getting attached to saying, hey, I'm a gold bug or I'm a stock guy or I'm a Bitcoin gal, on and on. And so every asset having its time in the shade and sun. And so, you know, um, they go through cycles and we don't always know what's going to be the next big investment. My brother was texting me this week. Have you seen cattle prices? My God, cattle prices are through the roof, and last year that could have been lumber or year before the dollar or, the year prior US stocks or Bitcoin, who knows, right? The old phrase is the old adage, there's always a bull market somewhere. And so I think that's a challenge is most of us want to um, make that attachment and cheer for our own team. But I think something like gold, it's a bit unique. It's sort of got a different profile than almost anything. Not necessarily for better or worse, but here's a fun on our list of articles where we talk about here's an idea that would surprise you. I said you go back 50 years, and the same is true the last 100 years. Like the most benchmark institutional portfolio is 60-40, 60% stocks, 40% bonds. And it's been a great portfolio over time, right? Um, as and someone was saying, how gold was useless. You shouldn't invest in gold. There's no cash flows. Buffett hates it. Shiny rock, yada yada. And I said, well, let's run a fun thought experiment. What if you subbed out of the 60-40, you just replace the entire bond portfolio with gold? Like that has to just torpedo your returns. Stupid idea, awful, right? Over the last 50, 100, it literally makes no difference. It makes no difference if you swap out your entire bond portfolio for gold. Like what a crazy, like no one does that. I mean, you might have some Canadians or Indians or Chinese or Australians listening that might put a lot in gold, maybe. But, no one does that. And so but it's an interesting takeaway where you start to learn like pieces of the puzzle, how they behave during certain times and what are their roles and why. And the better answer is not gold or bonds. The better answer is both. Have some of both. You don't feel like you have to go all in on one thing.
That's awesome. It's kind of like you were talking about earlier, like every asset class having a place, or not necessarily trying to predict what's going to happen next month, next year. We always like to say we're not trend predictors. We're trend followers. There's a difference, obviously.
Yeah. That's why I like I attribute, this is a Meb original. The problem is anyone under 40, I don't think knows either of the references, but I say it's better to be Rip Van Winkle than Nostradamus when it comes to investing a lot of your money. And so youngins, Nostradamus was predicting the future. Rip Van Winkle famously fell asleep under a tree. And so I think trying to predict what's going to happen, I think is fraught with a lot of danger. It doesn't mean we don't think about it, and run simulations and test out ideas. But there's a great quote where it says price. I think this is Ned Davis. You have to check it. It says price is a unique variable and it can't diverge from itself. Every other variable, you could say, oh, this is overbought, or oh, wow, the U.S. stock market's expensive. It can always get more expensive, right? We're trading at levels similar to the late 90s, but look at Japan in the 80s. To get there, the U.S. stock market needs to double from here, right? So it's happened before. Things like India and China were trading P's of 50 in 2007. So, but price is the one that can't diverge, right? So the truth is always there in the price somewhere.
Well, if you have time, I'd like to shift gears and maybe do a part 2 here, and either we can record another time or if we know, we can do a part 2 and just talk about advisors specifically applying through Cambria, other methods. Are you okay with that?
Sure. Would love to.
Okay. So the first question's a fun one. What mistakes do you see financial advisors making when it comes to building client portfolios and allocations today?
There's a handful. And I think the biggest seduction is chasing performance. I think we ask people, we say, how long will you give an investment before that's underperforming before you sell it, right? Everyone always says 0 to 3 years. And we asked Ken French, Nobel laureate, um, and I think wait, no, Fama's the laureate, his partner. Anyway,
Yeah, Markowitz.
he's a smart guy. Anyway, he we said, how long, statistically speaking, do you need to know if a active strategy is good? And he said, without skipping a beat, he said 64 years. I said, okay, well, that's probably a little longer than most advisors are going to give something. But the point being is that like Vanguard has these old great studies, and they're talking about the best performing mutual funds, but this applies to Buffett too. Like how many years out of 10 or 12, like they underperform, and it can be many years in a row, right? We wrote a piece recently called "The Bear Market and Diversification," where we said the U.S. stock market's been on a heater since 2009, outperforming everything relative to a diversified portfolio. It doesn't matter which one, 60/40, permanent, risk parity, endowment, doesn't matter. This has arguably been, in the last 100 years, the worst period ever for a diversified portfolio relative to the S&P in terms of years in a row and absolute magnitude of underperformance. I think it's switched in the last couple of years, but we'll find out. And so the point being is that, there's this seduction to always chase whatever's working, which I think the vast majority of the literature shows if you don't have a process for that is disaster. Because people get marketed whatever's working, they buy it. A couple years later, it's whatever's working then, they buy it, on and on. And so you see this play out in the flow data. And so the Morningstar publishes a lot of these studies. And the favorite that I used to Buffett wrote about this. I mean, not Buffett, Bogle wrote about this, top performing mutual funds per decade and how they did the next decade. This goes back to the 70s, on and on, reams of research that it's not a great idea. My favorite example was always Ken Hebner's CGM fund, where it did number one performing mutual fund, but the average investor in that fund not only didn't do 15%, they did negative, right? Because they just bought it after it went up. The modern equivalent, maybe Cathie Wood, on and on. But it's true for assets, it's true for subsectors, whatever's hot and enticing. And so I think, again, going back to having a process, and I think this is hard for advisors to think about, but trying not to let your entire process be driven by performance. And so the humorous example we always give, but it's true, so it's kind of sad, is, we have always something's not doing well. You got 20 funds, something's always not working, something's always doing great. And often people will call us or email or come by, or we're chatting and say, Meb, I bought your fund and it's done terrible. I've owned it for 6 months. And I'll laugh and say, it can get way worse than that. 6 months is nothing. Like, you think it's underperforming now? Like, this thing could underperform 2, 3, 4 years in a row. And they're usually taken aback because they're usually used to someone getting defensive and saying, oh no, it'll come back. This is why it's, da-da-da. And I say, you need to have like a reasonable expectations on, kind of some of these ideas. But what we've never heard in the thousands and thousands of conversations, someone comes up to me and said, Meb, your fund's done so much better than expected, so I'm selling it, right? Like, that's never, they say, oh, you're brilliant. You made me so much money. Thank you. It's done great. I'm so glad I bought this. I'm also brilliant. Pat myself on the back for my clients. They all love me. They never say, Meb, this is done so great. We're going to have to trim or sell this because it's actually like, we think we need to rebalance into things that aren't doing great, whatever. So the point being is that, the joke where it's not a joke, but the average advisor who's been in business for a couple decades, the average client owns like hundreds across the book of business, owns hundreds of funds. And that's crazy, right? Like, how could you possibly have that many investment funds? Anyway, so that's the big one to me, is the process of not chasing performance, and whatever's hot is we still see, sadly, even at the pro level. And this, by the way, not just advisors. This is institutions. We pick on CalPERS a lot. These multi-$100 billion institutions, they do the same thing. They just have a little more sophisticated language.
Yeah, different jargon. What I see, or what I'm telling advisors, is whether it's the tariff crash, 2022, as you mentioned a little bit ago, fourth quarter 18, a lot of people probably forget about at this point. The U.S. Treasury downgrade in 2011, like, so much of this just has to have to do with advisors having a plan or rules, and it doesn't even have to be their rules. Like, it could be like with Cambria, like your rules, because in my opinion, clients just want to know two things, and this is the same thing every single time there's a correction. They want to know two things. They want to know, A, am I going to be okay? And B, are you doing something about what's going on right now? What's your plan? So in other words, am I going to get retired and stay that way, or both? And do you have a plan when it comes to my money? And if the answer is yes to both those things, I think the advisors in question are probably in really great shape. But if you don't
Yeah.
plan, and your plan is just stick with it, it's going to be okay, everything comes back. I think, especially as time goes on, more and more clients are looking for something more than that.
Well, this is the challenge with buy and hold. And look, we manage the buy and hold ETF. It's one of the lowest cost ones out there. And and we think buy and hold is great. The Achilles heel of buy and hold is the drawdowns, right? It's a feature and a bug, right? Markets are volatile. Like, they spend most of the time in some form of drawdown. Your traditional asset is only at all-time highs like a quarter of the time. And so that's just the reality of how it works. The problem is, for investors, is either they're not informed of the drawdowns they could face, and or they just emotionally, doesn't matter if you told them ahead of time this thing can go down by 20% or 40%. When it happens, it's totally different. And so um, I think, the drawdown problem is, the deeper it gets, the bigger the hole you got to dig out of. Down 50 is not 50 to get back to even. It's up 100. Down 75 is 300%. So trying to avoid those drawdowns, of course. But the problem with people is that, they anchor to the all-time high. And so let's say you started investing with a financial advisor, you got 100 grand, fast forward 10, 20 years later, now you got $1 million, and you got a family, and you got kids, and you got a house and a mortgage and college payments and everything else. And all of a sudden your portfolio goes down 20. You're like, okay, well, buy and hold, right? I got it. It's going to go back up. And then next thing you know, it's down 30. And, next thing you know, it's down 40. And this is why people behave so irrationally. As I said, look, I get that it could happen, but then it did happen. And the problem here is that I can't let it go down more. I knew that it could, but I cannot survive. This goes down 50 or 60 or 70, right? Like, I have payments to make, on and on. And so I just sell it all. Can't take it anymore, right? And so I can't tell you how many people we talked to post 2009. They said, "Meb, I sold everything. I couldn't take it anymore. Like, I had to get out. I could not watch that go to zero or whatever." And the problem is, as you know, being in a talking about systematic trend, it's okay to have an exit, but you have to have the reentry. You can't just say, "I'm always out," because I can't tell you how many people I talked to, not just in 2010, 2012, 2014, 2016, 2018. It's like, "Look, I sold, but I never got back in."
Yep.
And that's heartbreaking because, the markets, like I said, stock market's up 10x. So 2009, you had 100 grand. Now you got $1 million. Or if you were in the queues, 2 million. So I think the struggle with buy and hold has always been, uh, can you get to the finish line? And that's, to me, where trend following really comes in. And I think I'm probably the biggest outlier in the country, just about, as far as institutional investors, and how much I think that trend should be allocated to a traditional portfolio. I think a lot of people think 5-10%, and our default is 50, which is way way more than anyone else. But I'm okay looking different. I don't worry about that side too much. But trend has its own challenges. The biggest one is looking different than your neighbor when they're making hay and you're not. So
Yeah, it's like going fast sounds fun. The high dive looks fun. Roller coasters look fun. Skydiving might even look fun, right up until you're at the edge. And then it's just not so fun anymore. At least it's nerve wracking, right? We had a client not a client anymore, back in 2011, no, sorry, 2021, who sold out of the market literally at the bottom, March of 2009, and hadn't gotten back in 2011. I'm sorry, I said it wrong again, in 2021. So, 12 years has gone by, and they had about 1.8 million. They were only willing to put half to work. Over the course of a very short period of time, less than a year, they made about, I think it was somewhere like 7.5 to 8% with us, and then they fired us. And as far as I know, they're probably still not in the market now. But the anxiety is just,
yeah.
yeah. I mean, I feel like I screwed up because maybe I didn't listen close enough. Maybe I should have been even more conservative. But I feel for people like that, because you're right. I mean, at the end of the day, it's like when you look at this is old numbers, but if you go back to the 20 teens and you look at a 6% withdrawal rate on $1 million portfolio, and you put 100% of the money in the stocks, you have a 50% chance, like a 50% chance of running out of money. So 50/50, 6% withdrawal rate, $100 million. That same $1 million with a 6% withdrawal rate invested in bonds, you have a 100% chance of running out of money. So stocks are actually a safer investment, but people just look at risk differently.
Yeah, as we're kind of working through this new book, stocks on a daily, monthly, yearly basis much more volatile than bonds. You get out to about 20 years, and stocks, the rolling stock return is about the same as bonds, which is a really interesting, kind of magical transformation. And the good news is you have much higher, if you look at even the best and worst case scenarios, particularly on an after inflation basis, stocks almost universally are the best decision. They outperform most of the time, not always. And then they do so at a much higher magnitude, but at a longer time horizon, the vol gets really compressed. Now, the problem is the 20 years comment, right? Like you try to talk to someone and be like, just don't worry about it for 20 years. And that's tough, because they especially now, everybody's got a cell phone, everybody's got a account that's spraying confetti. It's hard, and I think one of the reasons you see people quote behave in some of the retirement accounts, where they kind of like don't see it all, they don't think about it, or have an advisor, like that's a separate kind of in between Chinese wall, in between them and nuking their own portfolio. And so I think the challenge, of course, is aligning people's expectations with the actual reality of what magic compounding can do if you just give it enough time.
What would you say of all the biases? You were talking about biases when we first started talking. We'll call it in part one. What would you say is an underrated or most underrated behavioral bias that's killing wealth building efforts, and what maybe practical tip might you give financial advisors to help fight it?
We did an old article on, if you guys remember, the older people listening, there's the old food pyramid. So when I was a kid, it's like, what'd you have for breakfast? It was like Frosted Flakes. You go to Olive Garden, you have 8 breadsticks. It's like the bottom of the pyramid is like the thing you should eat the most of is like bread, pasta,
Oh,
cereal. And at the top was like fats and protein, right? And I mean, fast forward 40 years, and the pyramid is not only different, it's like inverted. Like it's everything has changed in not too long period. And I think if you talk to investors from 40 years ago, it definitely would have been a little bit different than kind of investors how they are today. And there's always an evolution, but in general, I think a big one is always, everyone is obsessed, and it's sexy and it's fun and I get it. How do I create investing alpha? What's the best asset? What's the Fed going to do? Are stocks overvalued? What about Bitcoin? How much in gold? On and on. But the basics of like things like taxes, and not being, in inefficient vehicles. Obviously, we love ETFs, but I don't think a lot of people know this, but like certain mutual funds historically, like you could buy a mutual fund, be down on the mutual fund, and still have to pay capital gains. Like what a crazy setup! Like that's terrible. On and on. So I think thinking about the easy lifts like fees and taxes on ideas is a big one. The world's moving in the right direction on that, though it takes some time. We've been doing some kind of innovative work. I mean, I'll give you a good example. No one's going to like, and it's one of our smallest funds, so that will go to show you that no one actually does like this. But we wrote an old paper where we looked at and said, theoretically, if you're a high net worth investor, you got a bunch of money, you live somewhere like I do in California or New York, and you're reinvesting your taxable income in your investing account, theoretically, you actually don't want dividends and income because then you're just paying taxes on it. So if you could get that investing return without paying the taxes along the way, mathematically it'd be much better. So theoretically, could you replicate the S&P but without any dividend income? And we wrote a paper demonstrating that on an after-tax basis, you're much better off if you can. And so we launched this strategy. And the challenge is like, who wants a no-income fund? Like we were talking earlier, like all my dividend friends, like you crazy, like what a nightmare. But mathematically, if you're taxable, it's a better idea. Anyway, so I think the basic lifts of being aware of just kind of some of the easy things. A lot of that has to do with financial planning, talking to people. The biggest value of so many advisors is saying, hey, look, you should open a self-directed 401k, or here's how to convert this IRA, or you should be doing, this sort of tax moves. My favorite personal finance related tidbit, and so listeners, you can go try this and see, email me, tag me if you find a bunch of money, but for the old unclaimed money databases at the states. So you go to unclaimed.org, look up your name, your parents' name, your grandparents' name, your wife's name, your relative's name. Be a little careful with boyfriend, girlfriend, ex-girlfriends, ex-wives, because but you can look up Britney Spears, you can look up Barack Obama, Donald Trump, anyone, and almost everyone has unclaimed assets somewhere. In some cases, it's substantial. So we've had readers write into us that have found, usually it's like $100, $1,000. Some have written us that have found 10,000, 50,000, 250,000 before, which is pretty amazing. Anyway, that's a little bit of a sidetrack, but if you guys find a whole lot, let me know. We love hearing it.
Well, a big portion of the new Cleveland Browns stadium is going to be paid for with unclaimed funds, so I went and made sure I got my $24 from Nordstrom that was apparently hanging out there.
Oh boy, that's great. Hey, that's coffee and a bagel.
Yeah. Well, I apologize. This is my fault. I totally screwed up, and my younger son's behind me knocking on the door. I'm the defensive backs coach for his football team, and I've been having too much fun with you. Do you mind if we schedule just another 20 minutes, another time to finish up? I've got 4 more questions.
Yeah, man. This has been a lot of fun. Yeah, tell your son to emulate Pat Surtain. That's the one. That's the one you want to pay attention to.
That's awesome. All right, man. I'll look forward to you soon.
All right, cheers.
All right, see you.
Thank you for tuning in to the Advisors Fuel podcast. For more articles, videos, and resources, or to schedule an intro call, visit adrenalineadvisor.com. This podcast is for informational purposes only and should not be relied upon as a basis for financial or legal advice. Always talk to your compliance department before implementing any of the ideas shared in this episode.